Hello and welcome to the Simplify Your Retirement Podcast with Steven Strickland. We're going to jump right into it this time, but we're picking up where we left off last time. Steven, we're just going to jump right in and continue this conversation. We've got a lot of information to cover here yet today.
Absolutely. Yeah, we took one podcast episode. We made it into two. We'll try to keep it at two, guys, and not 2 or 3. Hopefully we'll be able to finish this discussion during this one right here. So hopefully you all are listening or watching this podcast after watching the first one, which is just about our bright portfolios, the investment philosophy, the methodology that goes into just building portfolios in general. And then today, something that I know you guys are both passionate about, and that is just diving deeper into portfolio construction. So if anybody listened to the podcast we just finished, anybody could do that, in the sense of any person that manages investment portfolios could share that same philosophy with us. There's a lot of people who might say, yep, that's exactly what I believe. I would do the same thing here. But then we take all that and we take it one step deeper. And we look at it from a screening philosophy, a methodology that some people call faith-based investing, faith-driven investing, biblically responsible investing. There's a lot of terms out there for this. So I want to talk a little bit about that, the biblically responsible investment philosophy and methodology. And again, if you're jumping in for the first time ever on this podcast, we're here with Mark Reifer, who started a firm called Clear Money Path in Rolla, Missouri. He's been managing portfolios in this philosophy and this approach since 1990. We've got Ben Malick, who started a firm in 2015 building model portfolios, or has been building model portfolios in the biblically responsible space since then. And then we also have Josh Barlow. Josh and Ben both are CFAs. Josh couldn't be on the podcast with us today, but he is part of our investment committee. And so these three guys and myself are part of the investment committee for Bright Portfolios. So let's talk about the Bright Portfolios, but also biblically responsible investing philosophy methodology. When we're looking at the universe of investments, to me, there's looking at what the industry in general looks at. You know, what do we exclude? What are you guys keeping out of the portfolios? There's that part, but what are we actually looking to include? And so maybe I'll just give it to you guys like this. You know, Ben, maybe you can answer what kind of companies are we looking at from this framework, saying we want those kinds of companies in our portfolio. What are we looking to include? And maybe Mark, you can tell us, what are we looking to exclude?
Yeah, so I think it might be a little better to even back up a little bit and just share why.
Yeah.
Why do we even want to do this?
Yeah.
And really for me, it's we want to do what's wise, and we think what's wise is doing what's good and what's smart.
Yeah.
We now I didn't come up with that. That's from our good friends at Eventide, but it resonates with me because that is what's wise, is doing what's good and what's smart.
Yep.
And so if what we're trying to figure out is, are there companies out there that are basically doing good? Are they doing good and meet all the financial metrics? So that matters. So the financial metrics matter to us, and we look at those just like any other portfolio manager would. Mm-hmm. But we also want to look at what kinds of products are these companies bringing to market. How are they treating their employees? How are they treating their customers? How are they treating vendors? The communities they're in? We're looking at all of that to determine, is this company actually doing good, or are they just trying to generate profit off the backs of other people and taking advantage of people for the sake of profit? Mm-hmm. And that's what we want to avoid. In my mind, we want to try to look at companies that are doing good and stay away from companies that are basically profiting from the abuses or addictions of other people. Because for us, the Bible calls us to love our neighbor as ourselves. Mm-hmm. And so if we are investing in companies that are taking advantage of people and using capital to own businesses where we're profiting from the addictions or abuses of someone else, I don't know that I could look God in the eye and say, I am loving my neighbor well. And so for me, that's where my conviction comes from. The reason I want to do this is because caring for people matters. Yeah. And in business, it's actually wise. It's actually good and smart to care for people.
Yeah, absolutely. That is good. It's good. It's smart. And it makes sense from a business point of view. It makes sense that those companies would tend to be prosperous as well. And so it makes it a wise investment decision to look for companies that are not mistreating people, exploiting people, and like you said, taking advantage of the abuses and addictions of others. So we're looking to include companies that get good scores in how they treat their employees, how they treat their customers, and what are they bringing to the world? What kind of products and services are they bringing? That are they benefiting people? Because obviously, if it is, and they are, that's a good business to own. It's a good piece of real estate, Mark, to own. It's a good piece of property to be an owner in. And so we're looking for those kinds of companies to include, but we're also looking to say there's certain companies that we don't want to own in our portfolios.
Yeah, I just echo everything that Ben says. And again, we've got to give an account before God with the advice that we give. And, it's really important to our clients. They don't want to profit from things like pornography or things that violate their values. So every client deserves the right to invest according to their values.
Yes.
So you look at the space of values-based investing. It's been around for generations. We can give you more of the details of that.
Yeah.
But ever since, even the slave trade, when that changed back in the 1860s, starting in Britain and then the United States, and you look at apartheid in the 80s. There's folks have invested according to their values for generations. So why not now?
Yeah.
So how do you put together a methodology for doing it? It can be a little tough. But for us, we look at scripturally. Again, our opinions matter, but not as much as what the scripture teaches, right? So, what are we compelled to do? And one thing is, in Proverbs 1:19, not to participate in ill-gotten gain. We are not to profit from ill-gotten gain, and to avoid that. So how do we identify that? How do we define that? So we look at companies, the three things, the three Ps, right?
Okay.
So the first thing is we look at their profits, their products. So does that product or service generate revenue? But is there a fundamentally immoral product? Well, there's very few products that are immoral. So that said, pornography is one of those.
Right.
And so that's something that we do not want to profit from, even if it's a portion of that company's business. And so that's kind of a zero tolerance for us. Again, we don't want to violate the ill-gotten gain principle.
Right.
So we'll look at companies and we run screens on their products and their services. And again, we don't charge extra for this. It's just we believe it's the right thing to do. And we gladly teach other firms. A quick point is, you just won't get this from other firms.
Right, exactly.
We would be delighted if you could.
This is the differentiator. A lot of people will share our first philosophy of general investing, but this is where we take it one step further.
Yeah. And so, but again, we're not here to trade on the name of Christ in that way, and we do this at no extra cost. It's just the way we do it. But we'll look at the products, and then we'll look at their processes, both internally how they treat their people, and externally how they treat their vendors and suppliers, that type of a thing. And thirdly, we'll look at their priorities. Where do they spend their charitable dollars? What kind of stance might they be taking in the marketplace? So it's not at all meant to be a blacklist. It's really to be relational with the folks that we're investing in. We want to partner with them in a way by owning shares of their company. So we do have a methodology for doing it. And we look, we score them both from a negative standpoint, but also from a positive. What companies score the best from products and services, and in their processes, and then also indeed their priorities.
So there's metrics for each one of those, and there's a scoring methodology. I guess you give certain companies a score based on their products, their priorities. Notice it could be included, even though we may not say, hey, we don't agree with 100% of their priorities, but their products and their people, these kinds of things are good, and so all together, this is one we could invest in.
Yeah. So an example on the S&P 500, is an index of 500 companies in the United States. Running through our screens, how many would not pass that? And again, how many have fundamentally immoral products or services? And there aren't a lot. So really, it's going to be anywhere from 375 to 400 or more of those companies make it through our screen. So there's plenty of investment opportunity out there. And
so that's great. I always love hearing that. So in other words, I think it's important for people to understand that when we're looking at the S&P 500, and we look at the 3 Ps, and we take our screen and we say, from Bright Portfolio's point of view, we could own the S&P 500, and that's what people would do if they followed the first part of our philosophy. Hey, you just want to own large cap stocks and a standard deviation, a model portfolio. But we say, look, we're going to look beyond that. We're going to look at these 3 Ps. We're going to try to derive value. We're going to look for companies that are good, that are smart. So if we take our screening, our values-driven screening process against the S&P 500, you're still left with 375 to 400 companies. And what I want people to understand is that 400 companies is still a diversified portfolio. I don't need 500 to be diversified. 400 is diversified. And a lot of times these 400 are performing. It's going along with the S&P 500 anyway, but you can feel good about the companies that you do own.
Yeah, at least the universe, definitely plenty of opportunities out there. And then smaller companies, there's a good number of the mid cap or small cap that make it through our screens more so.
So, when I look at Bright Portfolios, Ben, we've been doing this together for a while, and we're glad that Mark and Josh are on the team now to look at these, portfolios with us and help us with their expertise. But we've always been focused on good returns. I've told my clients at Wise Wealth for years that we want you to get good returns. And obviously, when we say that, we're talking about the rate of return someone's getting. That's obviously extremely important. We're looking for that. But our definition of good returns goes beyond just the rate of return. And it goes into what you guys are just talking about. And that is, hey, we want you to feel good about the companies that we own. We don't just own every company that's out there that's publicly traded, which some people would. It's just a broad-based, market approach. We say, look, we're going to be broad-based. We're going to be diversified. We're going to own a lot of these companies, but we're going to be selective in choosing these companies because we want you're a part owner. Which goes back to the other discussion. You're a part owner in these companies is something real and tangible, and we want you to feel good about these companies, but the returns do matter. And so I'm glad to say that historically, people that invest in companies that are doing good, that are screened for these sorts of values, what are the results? In other words, is there alpha? I know, Mark, you've got a track record. You've been doing this for a long time. What is the track record in choosing companies that pass these screens for you, for our clients?
Well, a little bit of backdrop, too, is it used to be a Christian Investment Forum, now Faith-Driven Investor, has some third-party studies out there. So there's more third-party data being accumulated about biblically responsible investing or faith-driven investing. Socially responsible investing has been around longer, more formally. So that said, that the data is showing from third parties that having a values overlay with a portfolio tends to enhance the performance as opposed to being a detractor. But the data is pretty clear that you're not going to sacrifice performance by having a values-based approach. So that's across a variety of studies.
Right, that's huge. And I think at some point in time, that's been kind of like the misconception. Well, I want to invest in a values approach. I know I'm going to give up some returns to do it, but I still want to do it. There are some people who would say, if it matches my values, I want to do that. But you're saying that the data, the historical performance says you're not. In fact, you're enhancing a lot of times your returns.
Correct.
Okay.
And I think it's important to jump in here and say that does not mean that it will outperform in all time periods all the time. In every 1 month, 3 month, 5, 1 year, whatever. So you have to keep that in mind that these studies that we're referring to are over a long period of time. And just like anything, there will be times of outperformance and underperformance in the short term. But overall, like Mark said, it has shown that you have not had to sacrifice performance in the long run when you invest this way.
Okay, good. And so you've been doing this, Mark, for a long time, building some of your own model portfolios. And so following the same methodology we just talked about, some of the same screens that we just mentioned, following the 3 Ps, how has that portfolio performed? And we're talking about large stocks or medium-sized companies, and we're talking about stocks.
Yes.
Okay.
Bonds too.
And bonds too. Okay.
Because you apply the same 3 Ps to whatever asset that we're looking to buy. So one of the things we don't have an official track record or audited track record. So that's something we're working on and compiling and some other exciting things coming down the pike. So what we've seen though is, and really what you're after is, are you capturing the asset class, the historic performance of the asset class? And Paul had a great comment our last episode. What does that asset class trying to do for me? What am I really trying to buy?
Yeah.
And the reason why you own companies is because they have higher risk but potentially higher returns. The whole reason why we even bother is because, how much was a postage stamp 25 years ago?
Yeah.
It was 18, 20 cents. So we have to have something that fights inflation. So we want to own businesses, great businesses over time. So we need to participate in that asset class. So all of our portfolios have absolutely participated in that. And then we've had outperformance, some years more than others. And we're compiling some track records. And so I mentioned that universe of stocks, 375 or 400. I've been tracking that for a long time, just internally, and looking at that. And that universe has had performance that's in line or better than the S&P, which is very encouraging. So we take that universe and we do a subset of that, and that has had commensurate participatory performance. So hopefully we have a audited record we can officially give to you. But bottom line is it capturing the asset class? And the answer is yes.
Okay, good. So people, when we're talking about a values-based approach, we're not, sacrificing returns, which people might automatically assume.
Right.
In fact, that's the exact opposite of what any portfolio manager is trying to do. We're trying to enhance the returns, trying to get the best, risk-adjusted return we can get for the risk that we're taking. And so this is no exception. In other words, we're not just looking at values above all else, and therefore, the returns don't matter. The returns still matter to you guys.
Absolutely. Yeah. Both disciplines, the financial and also the moral disciplines are part of our work.
Right. And so I know you've developed another sort of, maybe top 40, a list of companies that you've been looking at, that you have been tracking, that you've had clients in. And so it still follows the same screening process, methodology. And so, but there has been some exciting alpha. There's been some exciting outperformance in that portfolio.
Yeah. Again, trying to put some formal things together. We track, we call it a best picks, which instead of just having a broad 400, holding type of portfolio, can we select the ones that we like the best? In those, again, trying to identify companies that are in the middle of a robust profit cycle. So we don't trade stocks. We want to own them for a longer period. And a lot of companies, if they're in a really solid profit cycle, that can go anywhere from 6, 12, 18 months to a decade or more. So it's more about identifying where they are in that profit cycle and having a discipline for identifying, but also then for reducing the position when we kind of see that cycle starting to wane.
So we talk about feeling good about the companies that we own. We talk about analyzing these companies, for these the 3 Ps that you mentioned, and feeling good and excited about companies that are doing good in the world, that are smart, that are good. What companies come to mind? I think it'd be good for our clients here, maybe about 1 or 2 companies that you guys know of that's included in our portfolio that our clients are owning in Bright portfolios. Any one of them come to mind you guys want to share? You want to talk about?
Boy, there's several. That we like quite a bit. Vertex, a company out of Boston. It's a pharmaceutical company. And they do some work with cystic fibrosis, and they've got a pretty good pipeline of product. One thing they're working on right now is pain relievers that are non-opioid. And boy, what a benefit that can be to society. And it's just a well-run company. They're in the middle of a good profit cycle, and we own that stock. That's one we like quite well.
Good.
O'Reilly Auto Parts is an interesting company. It's been a wonderful performer. We've owned it for years. The fleet in the United States, a vehicle fleet, averages 10, 12 years of age. So there's no shortage of people needing to fix their cars. And that may sound like a real boring company, but
that's nothing AI can't do that for you.
That's exactly right.
You can't go to Chat GPT and fix you might be able to ask how to fix your car, but you're still going to need the parts.
And you mentioned AI. So our bent in the portfolio has been really to capture the early stages of AI is the infrastructure. What companies are building the building blocks for AI. And so, NVIDIA, is one of our key holdings, but because its best customers? Well, Oracle and Amazon and Microsoft are big customers, and they're investing a lot of dollars in NVIDIA to build it out. So we own a lot of the underbelly of which has less risk to it as well. So a lot of companies that we're real pleased with.
Okay, good. Ben, anyone you want to share?
I just think of one comes to mind as one. It goes a little bit along that vein of Palo Alto Networks.
Yep.
They provide data security. They're big. I mean, if you think about a product that adds value to people's lives, I mean, in the world we live in today, a product that protects people from hacking and that protects their data is a huge win for society. And so just from a product perspective, I mean, I think that's a really great company to invest in. But like, know this, and none of this is financial advice, right?
Right. Absolutely.
We're not saying buy these right now. We're on here talking about different companies that are adding value, and that we may have in our portfolios at the time, but that doesn't mean 2 years from now we'll have them. So we'll just, but we do. These are ones again. We know where we are right now. We know what these companies are doing, and it's good stuff.
They fit in the context of a long-term investment portfolio.
But thank you for your compliance.
Yes, we're in compliance.
So as a reminder,
thank you.
This is not advice. We're not telling you to buy these companies. These are great companies that
right.
we may own from time to time in our portfolios.
Right.
But it's not advice. But I just wanted people to know, because there's a major disconnect. I can see the name of the fund that we own. I can see the name of the ETF, and it's like, okay, you know what I mean? People look at this and it's like, well, I don't know what that is. But obviously when someone owns a fund or an ETF, there's a bunch of underlying stocks or bonds in there. So what are some of these companies? And I think that's what's exciting for people to know. Hey, you own this company that's doing this. I mean, you're a part owner in that when you own Bright portfolios. I think giving people more of that, is helpful.
Helps us stay for the course.
Yeah.
Go ahead. You think of clients over the years who may have worked. I remember a client, he worked at Ford Motor Company years ago. And, he had his pension from Ford, had Ford stock in his retirement plan.
Oh, yeah.
He has since passed, but a dear man. And I remember he had the bulk of his portfolio in Ford. Mm-hmm. And he came to me and I said, well, I think we need to diversify this. Let's maybe keep some. But he understood Ford stock.
Right.
He knew about the company.
Yep.
He was very much in favor of keeping a significant portion of it because he knew the stock.
Yes.
Now, we did diversify it,
right?
And that was turned out to be for his benefit. But the point was he understood that company because he had ownership and knew more about the company. And our job is to make sure they stay in it for the long haul.
Yep. So Bright portfolios, basically it's our asset allocation model type portfolios where you can put a collection of either stocks or bonds. It could be balanced, conservative, aggressive, any sort of model in there. Anything that you guys want to tell everybody, anything exciting happening at Bright portfolios? I know we're constantly monitoring this, looking at the portfolio, construction, what funds and ETFs and mutual funds should be included, which ones should be excluded, maybe what percentages. Should we ratchet up the percentage here to this asset class or ratchet down that one, all within certain rules and parameters? And so I think the main thing for our audience and for Wise Wealth clients in general, just because I preach so much of being disciplined, of staying in the investments long term, in the results that you get by being in the market, by maintaining your portfolio allocations, by discipline, by not buying and selling, getting out. I think that's important from the investor behavior level. But from a portfolio manager standpoint, what I love about this conversation is I think it's good for our clients to know. You guys especially are in the weeds. You're looking at these companies. We're constantly looking at that to determine, what levers you can pull, what allocation, what percentages, and, constantly. And so from Bright portfolios, anything that you want to tell everybody that to be on the lookout for, anything exciting happening at Bright portfolios that we're working on?
Well, in the industry itself, the biblically responsible investing space or the values-based space, it's good to know that is a growing space. Mm-hmm. We're seeing more products come to the market.
Yep.
When I started, there was nothing.
Yeah.
Years ago. It was a long time ago. I realized it. But over that period of time, we've seen more and more our participants and money managers in that space. So that's an exciting thing as well. And again, we're hoping to add to that mix at some point.
A lot more data out there, you know what I mean? A lot more things we can analyze that we couldn't before. And so I think we can find out a lot more about these companies than we used to be able to as well.
Yeah, and with the explosion of products that are out there in the faith-based or biblically responsible world, it becomes even more important for diligence in finding those products that fit into our model portfolio. So that's part of our work, is making sure we're on top of what's coming out and making adjustment. If there is something that might fit, doing the due diligence on that particular product, see if it's something that might fit in our models, and inclusion or exclusion based on certain factors. So we look at each product that's available out there that we can for inclusion or exclusion from the portfolio. So there's quite a bit of diligence that goes into just picking the right products. So, but as far as on the update front, I mean, we're constantly monitoring. There's a few new products out there, and again, Mark said we might be looking to add to that as well. So
that'd be great. And then, just from a rebalance standpoint, someone's in a model portfolio or philosophy, what, annual rebalance typically?
From an asset allocation perspective, yes. Okay. But from a individual holdings perspective, that's managed a little bit. On the individual stock holdings for client accounts that have that, Mark can speak to that, but that's more as needed based on their fundamental analysis.
Yeah, it's interesting. Data suggests that 2 out of 3 money managers do not outperform their respective benchmark. Mm-hmm. So I think the biggest point from that is, in a passive benchmark, just an index, there's a real benefit towards not over managing.
Yes.
And I think that's as big a story about indexes as anything. Don't over manage. Mm-hmm. So that's one of the things we try to do is to make sure we're not in the over management business. Yeah. So we're long term. We're going to make adjustments. I've been doing this a long time. The 35th year, you don't make money by trading anything over the long haul. So that said, we're going to make adjustments on the individual holdings portfolio. We monitor positions daily. Because we want to stay on top of the information flow and their earnings cycle. But generally, we'll rebalance it, look at it hard every month. Mm-hmm. But generally, it's more of an adjustment type of a process where certainly every quarter you get more good information from companies when they report earnings and provide guidance. So we make adjustments as needed, but monitor it all the time.
I gotcha. All right. So, there you got, there's kind of like, Paul, under the hood, as you said at the end of the last podcast. And some people just want to know, hey, I just want a 75% stock, 25% bond portfolio. I want something that's going to average me 7% per year or whatever is net of fees. And we choose. Our advisors here, most financial advisors, are going to say to the client, look, here's an asset allocation model portfolio already built, constructed by these guys right here. That portfolio is designed the way that it's built to get you 7% of your net of fees. It goes up and down in value. There's no guarantees, all these things, but it's designed to do that for the least amount of risk. So when we're talking to clients, that's what we're focused on. But at least we got to see behind the scenes what these guys are trying to do to make that happen. And I think the most important thing is it's a careful, thought out process. It's not just a cookie cutter. We're being diligent in the work we're trying to do. We're looking for a philosophy that gets people the returns they need, but also a principled approach, an investing philosophy that glorifies God, something that you can feel good about the companies that you own that are doing good, that are doing smart. We believe that will enhance your portfolio's returns. You got to stay with it long term. And those kinds of things. Anything else that you guys want to add in here before I let you go? This is your last chance to say anything about Bright Portfolios, about the philosophy. I'm going to hand it back to Paul. He's going to close out the show, but thank you guys for being with us today. Mark, anything?
Great to be here. Other than it's a privilege to build portfolios for clients, and again, to know what you own is such a helpful thing in the whole process, and we're excited to do that.
Ben?
Yeah. I would say, just harkening back to why we do this, I would say the values-based approach is a financial approach in a sense. Because we think the financial success of companies is an outcome that's derived from the process of caring for people. And companies that have that built into their process of caring for people, they will be more successful financially over the long run. Absolutely. That's our belief, and that's why we think these things are just there's no separating them for us.
Makes sense to do it, literally.
Yeah.
So we're looking for good returns, companies you can feel good about, and returns as well. There's a reason why we don't we don't see Ben that much. It's really why Josh Barlow is not here. The CFAs, Mark. These guys are behind the scenes, they're in the weeds. You are too. You're a guy that gets in there behind the weeds and looks at all those things, but you still face clients. But Ben, normally Paul, is behind the scenes doing the work we're talking about today. This is a technical work, and we appreciate what they do, what Josh does, and even Mark. He's able to wear both hats effectively. So, but this is great today just to see under the hood how we build the portfolios, and we're excited to continue to grow. You know, I think all of us have a desire to continue to learn, to get better, which is what what our clients expect of us. We're fiduciaries. We're trying to do what's in the client's best interest. That comes from portfolio management. That comes from just us as advisors, continuing education, continue to learn. We're not stuck. And so I think it's an exciting thing for people to understand. We're constantly growing. We want to get better. We want Bright portfolios to be the best portfolios they can be. And there's a lot of reasons for that, but mainly for our clients' benefit, for the benefit of mankind.
Mm-hmm. So. Well, and it's great to hear because, you know, as I meet with clients too, and we meet with clients all the time and look at these reviews, what you're talking about today, we see where we're not sacrificing performance.
Yeah.
So yes, there are times that we might not win in a short term, but over time they do what they're supposed to do, these portfolios. And so it's interesting talking to people and seeing that they don't know that this even exists. Many people don't know that they can have their investments align with their values, that they can have their investments align with their values and not sacrifice performance. And so for you, if you're watching this or listening to this and you didn't know that, maybe this is your first exposure to it, give us a call. We'd love to talk to you about it. Give us a call here at 816-246-9473 or email us at info@wisewealth.com, and we would just simply start with a conversation. But if you know about it, you benefited from this, and you know someone else who would love to know about this, share this. Share this episode with them. It's great to be able to hear that. Mark, Ben, appreciate your time. Stephen, as always, thank you for having guests on like this to be able to continue to not only show that we're continuing to grow and that we're acting in the best interest of our clients, but for our clients to be able to learn and be able to look under the hood every once in a while and understand how all of this fits in the context of their plan, but still it does come back to the plan. And so we appreciate your time, guys, and thank you. And for you who are watching and listening to this, thank you. You're the reason we do this. Without you, we wouldn't be here. And so for everyone here at Wise Wealth, for the Simplify Your Retirement podcast, this is Paul Brock reminding you that financial peace comes with having a plan. And we'll see you next time.